Hello and welcome. This is the 44th episode of What Would Peter Lynch Do?, where we explore the wisdom of legendary investor Peter Lynch. We got a fantastic question from a listener that really gets to the heart of what's driving the markets right now. They asked, there's a lot of debate over interest rate cuts. I've heard the CPI index plays a significant role. Why is that? And why is the stock market affected by this index?
It is a brilliant question, because once you understand this relationship, so much of the financial news just clicks. So today in this explainer, we're going to break it all down. What the CPI actually is, how it steers the Federal Reserve, and most importantly, what it all means for your portfolio.
All right, so let's start with the first piece of this whole puzzle, the CPI. What in the world is the Consumer Price Index, and why does everybody seem to freak out about it every month?
You know, the easiest way to think about the CPI is like a giant shopping receipt for the entire country. It tracks the average price changes for a big basket of things we all buy. We're talking everything from milk and bread to gasoline, rent, and even haircuts. Basically, it's the government's official way of measuring inflation, or the cost of living.
Now here's where the Federal Reserve, or the Fed, comes into the picture. Their main job is to keep prices stable. And for them, the sweet spot, the magic number for inflation, is right around 2%. So if the CPI report comes out and shows that prices are climbing way faster than that, the Fed starts to worry that the economy is overheating, and to cool it down, they pull out their main tool. They raise interest rates. On the flip side, if the CPI is hovering near or even below that 2% target, it's a huge green light. It tells the Fed that inflation is under control. This gives them the room they need to do the opposite, to cut interest rates. That makes borrowing money cheaper, which gets people and businesses spending, and it helps give the economy a little boost. So you see, the CPI really is like the Fed's report card. It tells them whether to hit the brakes or step on the gas.
But here's a little insider secret. Even though the CPI gets all the media attention, the Fed actually prefers a different measure called the PCE index. And why is that? Well, it's just smarter. It's more responsive to how we actually behave. For instance, if the price of beef goes through the roof and everyone starts buying chicken instead, the PCE picks up on that shift pretty fast. It adjusts every quarter. The CPI, on the other hand, is a bit slower. It only updates its basket of goods every couple of years.
Okay, so we know the Fed is watching this inflation data like a hawk to decide on interest rates. But how exactly does that decision in a boardroom in Washington, D.C. end up affecting the stock market and your portfolio? Well, it's all about a chain reaction.
I want you to picture a set of dominoes. The first domino to fall is a good inflation report, a low CPI number that signals prices are stable. That knocks over the second domino. Investors see that good report and immediately start expecting the Fed to cut interest rates. And that expectation, that's the key. It's what knocks over the third and biggest domino. Stock prices tend to go up. So let's look at the three main reasons why that happens.
The first reason is just simple math. Most big companies have a lot of debt. I mean, a lot. So imagine a company with $1 billion in loans. If interest rates drop by just 1%, that company suddenly saves $10 million a year. That's $10 million that goes straight to their profits, which, of course, makes the company's stock look a whole lot more attractive.
Okay, the second reason gets a little financy, but stick with me, it's actually pretty straightforward. A stock's price today is based on all the profits it's expected to make in the future. To figure out what those future dollars are worth today, you use an interest rate to discount them. So when that interest rate goes down, the discount gets smaller, which means those future earnings are suddenly worth more right now. And third, it's just plain old competition. If your savings account is paying you next to nothing, you start looking for other places to put your money. And the stock market, with its potential for higher returns, starts to look pretty good.
We keep talking about the Fed like it's some single mysterious entity. So who are the actual people in the room making these huge decisions that can literally move trillions of dollars around the globe? Well, the decision is made by a group called the Federal Open Market Committee, or FOMC for short. It's a 12-member committee. You've got 7 governors who are appointed by the president of the New York Fed, who always has a seat, and then 4 other presidents from the regional Fed banks, and their spots rotate.
And this next part is maybe the most crucial thing to understand about its structure. The Fed is independent. A U.S. president can't just pick up the phone and order the Fed to cut interest rates to make the economy look good before an election. It was designed this way on purpose to try and keep short-term politics out of long-term economic decisions.
So now that we get the mechanics, we have to ask the billion-dollar question. As a regular investor, should you be spending your time trying to guess what this committee is going to do next? Well, when you look at the greatest investors of all time, they are fiercely, completely divided on this.
In one corner, you have our guy, Peter Lynch. He was famous for saying that trying to predict these huge macroeconomic things is a fool's errand. He believed that for most of us, trying to outguess the Fed is just a risky distraction from what really matters.
And Warren Buffett is right there with him. He famously said that even if the Fed chair whispered the next move in his ear, it wouldn't change a thing for him. His philosophy is that if you own a truly fantastic business, things like short-term interest rate changes are just noise. The great business will win out in the end.
But then, in the complete opposite corner, you have an absolute legend, hedge fund manager Stanley Druckenmiller. And he says, forget earnings, forget everything else. The only thing that moves the market is the Federal Reserve. To him, the Fed controls the flow of money, and that's the powerful tide that lifts or sinks all boats.
So what do you do with that? You have two totally opposite playbooks from some of the most successful investors who have ever lived. Where does that leave you, the individual investor, trying to navigate all this?
Well, it really comes down to choosing your own philosophy. You can go down the Druckenmiller path, become a macro expert, and try to bet on which way the economic winds are going to blow. Or you can take the path of Peter Lynch and Warren Buffett, and instead focus all your energy on what you can understand, finding wonderful companies that you believe can do well no matter what the Fed decides.
This famous quote from Peter Lynch just perfectly sums up his entire approach. For him, the real work, the real advantage, wasn't in predicting these giant, unpredictable forces. It was in doing the simple, hard work of understanding the business you own. And that's a principle that applies not just to investing, but to a lot of things in life. The final question isn't just, what will the Fed do, but maybe, which game do you want to play? See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a great day.